pendulum concept is an important framework to develop regardless of whether you are a mean reversion or continuation trader. In these case studies, I am going to show you some examples to better understand my framework for parsing and interpreting different stock charts from this lens. I want to emphasize that the pendulum concept does not mean that any stock can't go further in a direction. But ultimately, in situations where there is not fresh news, you tend to always get some level of counter trend that either takes the form of consolidation or more often a pullback. The first example is a daily chart of ARM. On February 8th, 2024, we had an epic breakout on earnings during AI mania. Because that move was on a fundamental news catalyst, earnings, I very rarely will want to short on day one unless the intraday is absolutely incredible. The next day is an inside bar, meaning the high and low of the bar are within the prior day's high and low, which is often a sign of price acceptance. Day 3, we explode higher again, and the rubber band starts to get stretched upwards. Because this day's move isn't on fresh fundamental news and we stretch far from the earnings range, I'm more open to shorting day 3 than I was on day 1. We do end up pulling back and we end up finding a trading range around $130. The more we consolidate in a range, that is a new equilibrium being formed and the rubber band or pendulum is no longer being stretched. Essentially, this range develops as roughly $120 by $150. We break below the equilibrium range and drop $30 very fast. Because this isn't on fresh news, this is something I view as a stretching of the pendulum, and I'll be open to the idea of reversion towards the equilibrium range. Let's now dissect an intraday chart, GME on May 14th, 2024. This was when Roaring Kitty came back and sent the stock to the moon again. We had some wild pre-market action this morning, and because we are steadily trading in the 40s, I would call $45 roughly the early pre-market equilibrium before we break higher. Because we're breaking higher so sharply and making such an enormous move, I am viewing that as a stretching of the pendulum. Given just how huge that move is and how sharp it is, I would say we were approaching a positive 8 on the overextended pendulum if positive 10 on the scale is insane capitulatory euphoria. We then revert sharply and retrace about 50% before we find more of a new equilibrium around $65. Off the open, we crack lower, retracing the whole pre-market move at a sharpness that I would rate a -7 or so, if -10 is peak waterfall panic. The more recent the price data, the more time spent, the more volume done in an area, the more it tends to take precedence. I kind of view it as some weird weighted average across all those variables. After that attempt, we consolidated and found a new range of roughly $45 by $57.50, with an equilibrium of around $50 or so. When we break below $45 in a very sharp, severe move lower, that then qualifies as a stretching of the pendulum where I'd expect some type of reversion. Now, let's take a look at my actual executions from how I traded GME that day. While many would imagine I have one magical entry and exit, notice my actual executions reflect the pendulum. I am shorting on the upper ends of the ranges and covering or flipping long as the pendulum swings the other direction. The consistent theme, though, is that the red arrows, for shorts or sells, are always on the higher end of the ranges, whereas the blue arrows are as we are sharply dropping and towards the lower end of the ranges. What those arrows are demonstrating is my trading around a core position utilizing the pendulum concept. The third example is an important one. ASTS is a stock that has absolutely exploded over the last 6 months or so. What makes this chart so interesting is how extremely sustainable it has been, except for the most recent move higher at the time of this recording. Anytime we had a decent sized up bar, we would immediately consolidate across and then start to gradually grind higher. For the majority of this move, from $2.50 to $22.50, we really weren't that stretched at all. At no point would I have been interested in mean reverting it. It wasn't until August 15th and 16th that we started to get overextended, during which it offered a really nice intraday mean reversion short on August 16th. Slope and rate of change are everything, and almost all of this daily chart, except for the last couple of days, we were sustainably increasing, and in my lens, the pendulum was not stretched at all. I understand that this concept will still seem a little ephemeral, even after these 3 examples. Admittedly, applying this concept is much more art than science, and takes some time to get a feel for how stocks move in response to different continuation setups and reversion setups. Nevertheless, because this broader concept is important to my understanding of price action and what I commonly refer to, it is important for me to try to flesh it out here. I will continue to build on examples over time.